Now cash is relatively attractive.
Right.
So it's attractive in relation to bonds. It's actually attractive in relation to stocks. You have the classic movement, of course, as rates go up and money becomes tight, you lose the parts of the economy, the parts of the market that are the bubble parts that needed the cash flow.
Are you prepared for an economic collapse? Ray Dalio warns that it's not a matter of if, but when.
I think we have squeezed a lot out of the U.S. market. I think we're in an environment that we are going to have low returns going forward for a very, very long time.
Ray Dalio, one of the most renowned financial minds of our time, issues a warning about the looming economic collapse that could shake the very foundation of our financial systems and change the world as we know it.
Real issue is that we have a supply-demand issue of bonds because we're going to have to sell a lot of bonds to those in the world who own bond inventories. And they have very low interest rates, negative real interest rates, and they're overweighted in U.S. bonds, and they're going to have to buy a lot more.
As the world's economy has become increasingly unstable, it's essential to listen to the wisdom of experts like Ray Dalio and take action to protect our financial future.
Well, there's two ways of dealing with debt. You pay it back in hard money or you pay it back in soft money. You pay it back in hard money and you have a problem. You have a depression. So throughout history, whenever that was done, pay it back in hard money. Eventually, that was abandoned and you print money. That was what 71 was. That was what March 1933 was. I think that what you have to think about is the value of money. How much money does one have in debt instruments? And do you want to own that as an asset? I think they're bad assets. And so, and then how do you diversify? And the system also has to deal with what is money? What is money? Is the dollar going to remain the same sort of reserve currency?
By understanding the underlying forces at play and implementing effective strategies, we can position ourselves to weather the storms ahead and emerge stronger on the other side.
The important thing to know about this crisis, and that it happened in the 1930s, is that in order to get the checks that we're needing, a lot of people, a lot of companies need checks. Now, where will those checks come from? So there'll be checks from the government. The type of support we're going to receive is two types of support. Where's all this money come from? So the government, when they say, I'm going to pay more for unemployment insurance, or I'm going to give you a loan for a small business, or so on, where do they get the money from? Well, they either tax it, but if they tax it, that's bad. So the government, they can borrow it. That's what a deficit is. The government runs a deficit. And then the question is, who's going to borrow it when everybody's financially strapped? And the Federal Reserve says they have the power to print money, and they will say, I will borrow it and I will lend you the money. So the Federal Reserve is lending the money, and it is also lending others the money. Well, the things that I thought about, some of the things I mentioned earlier, the plan for the worst case scenario and make it terrific is one of the things. The understanding how to triangulate well to deal with whatever problems that you're going to face and how to work that through to find the path and find your nature. But also, one thing that's helped me a lot is meditation. Meditation gives you a calmness, an equanimity, so that you can almost look at your circumstances and you can navigate it with a clarity of thought without all of that stress. It's healthy because it reduces stress, and it also makes you smarter to make the decisions well. So I would say that would also be something that I would recommend. Because if you have the equanimity, that centeredness, that calm centeredness, and you have your plan, and you triangulate well with others so that you can get all the best advice and don't have to approach it in your own head, you're a long way there. there's productivity. Over a period of time, our living standards rise because we learn how to do things better, and the output per man hour worked increases, and that moves at a fairly, it'll go up and down its pace, but by and large, it's not what causes volatility. And around that, we have two debt cycles. We have a short-term debt cycle, which we understand because that's the business cycle. You know, you're in a recession, central banks ease monetary policy, they change the relationship between short-term interest rates, long-term interest rates, asset prices, put liquidity in, and then you have debt growth. Credit is spending power. Mm-hmm. So when you extend credit, you are extending spending power, and that's good for the economy when that credit can be paid back. And what it does, of course, is it pushes asset prices up while levels of debt continue to increase. And at that part of the cycle, people and everybody is sort of conservative about that, and it pays back. But asset prices rise.
When you say pay back, you mean the borrowers have the ability to service that debt even as asset prices rise?
That's right. And everybody wins, and that's good credit growth, and it's a wonderful thing. Then as you get later in the cycle, it's a very self-reinforcing cycle because as asset prices go up, you have more collateral, people are more confident, they believe asset prices will continue to rise, they become a little bit less careful in terms of that kind of lending, they extrapolate that into the future.
The cycle that I saw was brought about by seeing three important forces that I hadn't seen in my lifetime before, but happened many times in history, which is why I needed to study them, that cycle over the last 500 years. First, as you point out, when governments run out of money, they need more money than they can get. They create a lot of debt, and they print a lot of money, and it debases that money. We have had the largest debt increases and money creations, particularly in the leading world's reserve currency, the dollar, although that's been true in the euro and it's been true in the yen too. And that has a big effect. The second of those influences is really a political and social influence, which is the conflict between the left and the right, populism, often, typically, due to large wealth gaps and opportunity gaps, which exist in the United States now. And then third, as far as the changing world order, is the relative decline of the United States and rise of China and other countries. India, for example, of course, has improved its position, many countries. So that when the New World Order began in 1945, world orders come after a war, and then the victors in that war determine how things should go. When in 1945, when the United States won the war, it was the richest country in the world. It had 80% of the world's gold, and gold was money. And it had half the world economy, half of world GDP. And it had a monopoly on the military power, and it was the dominant world power. That creates a supply-demand issue that can create a monetary inflation, because there will not be enough demand to buy those bonds. And that means that it's likely that the Federal Reserve will not be able to taper or cut back and might actually have to increase to prevent interest rates from going up. And that's a classic monetary inflation. So that's my bigger concern than just the spurt. I think for most of the world, the real question is, what are interest rates relative to inflation, and also what is happening with all this liquidity, because there's a huge amount of liquidity. and negative real interest rates. And that means that it pays not to own any debt instruments. It pays not to own cash, certainly not cash, where you get no interest rate in an environment, like Larry says, of some amount of significant inflation. I think it'll be, let's say, in the vicinity of over 3%. So you get taxed at that rate in terms of buying power. And so when I look at that, I think you're going to see the continued inflation in other assets, and it pays to borrow a lot. I know, like to borrow houses right now, I mean, to buy, I'm seeing interest-only loans being made when there's basically no interest rate. In other words, you don't have to pay back your principal anytime soon, and the interest rates are so low, so there's a lot of money being thrown around that way. Those are the things that concern me more, because you build up a bubble. You saw the reaction in the markets when the Fed just even hinted at tightening. I don't think they can tighten a lot without having a big negative effect. So that's what it looks like to me, the whole picture of the low real interest rates, and then also the worries about the supply-demand, monetary inflation, and also the Fed tightening. You know, the way it works is you sell a lot of bonds. So now who do you sell the bonds to? And then when I look around and calculate who owns the bonds and what they have to buy and what the incentives of buying, they're bad. And in fact, you could see dollar selling of bonds. What that means is then the Federal Reserve is in a position of either seeing rates rise because there's not enough demand to meet that. In fact, if they start selling, it would be a very bad situation. And that they can't let that happen, because that would be very bad for the economy and markets and all sorts of things. So we have to keep in mind where we are. We're at the end of a long-term debt cycle. And that means that the Federal Reserve will have to do what they did last time, which is to buy a lot more to prevent the interest rates from going up. That's very non-cyclical. It's one of those cases where, you know, in reserve currencies, it's a very dangerous thing.
Now cash is relatively attractive.
Right.
So it's attractive in relation to bonds. It's actually attractive in relation to stocks. You have the classic movement, of course, as rates go up and money becomes tight, you lose the parts of the economy, the parts of the market that are the bubble parts that needed the cash flow, right?
Right.
So you're seeing it reflected in not only, long duration stocks, those that didn't have cash. So you see the tech stocks come down, all of that come down. You see private equity, you see venture capital because they needed cash. All of that comes down. A lot of things depend on a lot of other things, and the world and everything readjusts. What has to happen, I think, is investors, most importantly, have to realize two things. First, that cash is not a safe investment, is not a safe place, because it will be taxed by inflation. There will not be an interest rate that will anywhere near compensate. And it seems good because it's not volatile, but you're paying a tax of a few percent a year on that. So A, stay out of that. And then B, know how to balance a portfolio, because the way portfolios work, it's almost like for some part, something happens, another thing happens. In other words, what you can see in the markets today is that, let's say when equities go down because growth expectations falter and there's a greater likelihood of easing, then you see the bond market go up. And when you see other markets, gold, watch the market action on every day, and you could see those relationships. Wealth is not destroyed as much as it is transferred. And if you know how to balance those investments, we do it in what we call an all-weather portfolio. But if you know how to balance those investments, that's the most important thing. Be in a safe, well-balanced portfolio. You can reduce your risk without reducing your return. And you will not market time this, because even if you were a great market timer, the things that are happening can change the world, so it changes what should be priced into the markets.
Things that worry about me are the whole shift in terms of the quantity of debt money that's being produced that goes into create bubbles, creates an enormous amount of liquidity, and that I think will be manifest by either a rate rise tracing inflation or a dollar decline. And I think then we also have to deal with the changes in the political situation, the wealth gap situation. With the wealth gap is the left-right question. There's a lot of conflict in terms of left-right politics. There's a big move, pretty much probably, to more left politics, believing that there's not enough fair share of incomes and so on. And those will create structural changes that will have effects. The amount of money which has gone to profits has increased from about 6% of revenue to about 14% of revenue. And that's decreased the share that's gone to incomes. Those things could be structural changes that shift the wealth and income. I think we're here to those that are going to be more beneficial, let's say, to workers than to capitalists, I think, in general. That's particularly a U.S. issue. It is a European issue, too, although it's a world issue, but it differs around the world. So I think those are the bigger issues, that and the rise of China and what the rise of China means. Those, I think, are the bigger issues.